it be to the chairman of AMFI or CEO of Birla AMC?
CEO of Birla AMC.
I am representing Birla AMC right now.
It's very clear.
Not right now. Okay. So what are your fund managers doing right now? Let me ask you a pointed question. Are they taking use of the current rally to raise some cash, or you think the so-called summer correction has come and gone?
Of course, money managers has been quite busy in the last few weeks tracking the performance of companies. Of course, the quarterly results have been coming out. I think I see some kind of confidence coming back because most of the portfolio stocks have come out with good results, especially the holding that we have in the consumer-driven companies. They're all coming out with reasonably good numbers. There is some bit of confidence coming back, including some of the banking sectors. The way I think these were showing numbers, especially with a strong feeling that is coming in worst is over, especially around the NPAs and the way the resolution is coming, and the way I think stocks are performing actually in the banking and financial service sectors. I think that's actually building back the confidence, which actually missing piece. It's about a quarter back, where the entire market was coming down, and we are not knowing actually what to do and how to actually manage your portfolio. And these were actually full of confusion which was there, given the fact that there was a completely market was divided into two parts. The 5 stocks were driving actually the whole market, and rest of the stocks were actually going the other directions. With the results coming back, which is better than the expectations, I think I presume that confidence is coming back.
So the 5 stocks which are driving the market, how many of them did you own?
We own, of course. I mean, all the stocks we are owning.
Okay, so you should not be
you always have the question of are you owning sufficiently in your portfolio, or is actually insufficient, and that's the only dilemma that I think all of us go through every time.
But is it time to diversify out of that list of 5 names, or perhaps even time to deploy or rather have a greater allocation to mid and small caps? Because whenever the rebound comes in, and like you rightly highlighted, you know, earnings are beginning to see those yellow shoots emerge, perhaps the beta would be higher there.
Yeah, I think if you look back the last 5 years, if your portfolio have been constructed with the high beta stocks in the portfolio, with a large proportion of your allocations coming from the mid and small size companies, or maybe the next Nifty 50 kind of companies, your outperformance to the index would have been substantially higher. So that's the way I think money managers have been operating in the last so many number of years. That's the way the Indian markets also have been rewarding the investors in the market. But the last 6 months have been a bit unique, and the divergence got created. That again, from a portfolio point of view, if you have to actually correct your portfolio, you always correct it, but what remains actually is a slip between the cup and the lips. Is more about what are you owning sufficiently in your portfolio in order to have the outperformance that should come on the portfolio. And the case in point is some of the large stocks, the largest market cap in the index. While of course you need to have it as part of your diversification, but if you have to have it till the index weight, and portfolio manager do not do that, because most of the allocations they try and actually create an alpha through owning the stocks and the stocks which have got relatively higher beta, but the rate of growth also for those companies have been far higher than the large cap companies.
But
so
as
that's
a
the way
universe, do you believe that broader markets will play catch up, or do you think outperformance will remain with the benchmarks and the Nifty 50?
Yeah, this is what I just mentioned earlier. Yeah. The confidence is coming back with the performance of companies. It now is turning out to be a little better than what is being expected, and again it's coming from not only from the index companies, it's coming from wide range of companies, coming from the broader market. That's again it seems to be coming back. Therefore, one of the assumptions that we have been holding for quite some time is the worst is over. The results are now started coming better, and therefore we should see actually the performance coming from the rest of the top 5 companies should actually lead to a better outcome for portfolio constructions.
You also think the worst is over for the banking sector? Most of your funds have a very high weightage to the banking space and the financial space in general. What convinces you? Because so far, again, in the banking sector, it's really, yeah, I know the NBFCs have done well, some of the regional banks have done well, private banks have done well, but there are still a lot of names out there, especially PSU banks, corporate banks, which are lagging where you have positions.
Yeah. I think the way we have been seeing, as a fund house, we have been extremely bullish on the banks that have got very high focus on retail loan growth, which is done extremely well. At the same time, the last few weeks, we also feel that the way credit growth is now coming back, whether the bank's confidence actually lent to the corporates also now is coming back. We believe actually the corporate lending also will start picking up. So we actually turned over the bets a little bit more on the corporate banking as well. The banks who have been focusing largely on wholesale banking also we turn a little bit positive
But
actually
what
recently.
convinces you? What are you seeing in the data to give you the sign that things could be turning around there at a time when, you know, SBI still reported a loss? They're saying things may look up in the future. And, you know, we haven't, with rates going up, you know, the whole appetite of going out there and lending by corporates may be measured.
Yeah, I think it's coming from two sides. One, of course, the incremental demand for borrowing is not coming from corporates for setting up a new plant, but the incremental demand is coming for the corporates either for your M&A purpose or for the purpose of refinancing your existing loan. And given the fact there is one segment of the banking industry is cutting down their lending activities, there are another segment of banking sectors actually is increasing their lending book. So that's why I think the differential, the approach of these two banking system actually is benefiting some of the banks who have got an established credit appraisal process, and the credit underwriting capacity has been far superior to some of the banks who have been on the public sector side. And that's actually benefiting some banks who are actually on the corporate lending books as well. So this is actually the trend then that we are seeing, trend change that we are seeing. Second is on the NCLT, I think we are quite confident the way I think things are progressing after finding a resolution for at least 3 companies, including the Bhushan Steel, which got finally closed. And that's, I think, something seems to be increasing the confidence that worst could be over actually for that. But having said that, I think the way I think this is being projected is that as we move forward, there could be some more provisioning. While one can of course keep saying all the time that there will be more provisioning to come, at the end of the day we need to also of course draw a line. Actually, those sectors which have been built for the purpose of building long term the benefit of the country, like such as power sectors, one has to also find the solutions. I think there seems to be some step that is being taken by both the government as well as the intra-credit arrangement that the banks are working on as to how to find a resolution without actually going to the NCLT as well. Assuming they are able to fix those problems on these kind of different methodology, then everything will not get piled up actually to the NCLT, and therefore to put a pressure on the whole system of making a provisioning or maybe delay in finding resolutions.
Bala, are markets getting slightly complacent because nobody is reacting to a impact of interest rate hike? Nobody is talking about what is happening to the trade war and how the global trade would move. Lira is a problem, it may be localized, but the problem in Greece was also very localized, which could have broken down the entire European Union. So why are markets ignoring these hotspots? It reminds me of what happened in 2007 when the subprime problem was discovered, and the markets reacted to that problem after 8-9 months. I mean, the problem was discovered in July 2007, and markets reacted to that only in April 2008.
Yeah, I think it's a good observation. Again, having said that, I think if you look at the last 1 year, the markets have been consolidating. And the last 5 years, of course, we saw a good bull run, and last 1 year has been bad, except the index have done better than the rest of the indices. But there are also severe correction that has happened. Though it's not reflecting the index, is not reflecting on the Nifty or Sensex, but broad markets have given a corrections. Having said that, this year, if you look at the monsoon has been pretty good, and then the agriculture growth, I think, likely to be better than what has been the last year trend. And third is with respect to the inflation largely under control. The risk, of course, which has come, it's in the oil, but oil, of course, settling down at whatever the current price is, close to about 68 to 70, where there was a fear that oil will shoot through the roof, and that fear, I think, seems to be coming down. But currency, of course, is reacting in line with what we are seeing in the emerging market. And the emerging market, actually, I think more than India, emerging market has been going through a tough time, including Europe. We have seen fund outflow in actually some of the total return fund, which is being managed by some of the large fund houses in Europe. And having said that, but India is relatively on all these factors and macro point of view, we are reasonably insulated. And that's one of the reasons I think is reflecting on the market stability. At the same time, the GST is now settling down. Therefore, the tax collections will be better than what you have seen in the past. Therefore, in totality, look at it, there are a few areas where we are showing an improvement. There are a few areas where we are seeing deteriorations, especially on macro variables, on current account deficit, as well as on currency movement.
Okay, so closing comments, Bala. Which is one scheme or one asset allocation do you think could work for next 12 months? Because in next 12 months, you will perhaps get a better clarity as to how trade war has impacted global growth. We will be dangerously close to the election verdict. We may also get a clear indication which way earnings are moving, because now if earnings don't pick up, markets will get really disappointed and bothered. So you may not see a very you may not see a very linear move. You will actually see a very volatile market in next 12 to 18 months. So does it make sense to, let's say, buy balance fund rather than equity diversified? Does it make sense to put 25-30% of the money in debt rather than putting everything in equities?
So I think every time we have seen, whenever we have seen this kind of volatility, there is one factor, of course, gets revisited, which is the flight to safety. The flight to safety, when it comes to the question of equity, it has to be in the name of a balance fund, or it has to be in the name of consumption-driven companies where you make an investment. But that's one way of actually hiding yourself, and don't take a bet on actually the market volatility. Do go down against the trend. And second is the fixed income. As the yields have gone up, I think one of the big opportunities that has come for Indian investors. The bond yields have gone up. In the last few years, bond yields have gone up. Even the currency moving up, I think bond yields will go up. So therefore, some allocation can also actually go in towards fixed income, which can actually give you a better an experience to the investors and take a better actually in the longer term investing, especially through the large cap companies. Maybe we'll even a little later.
Okay, Bala, appreciate your time. Glad you could join us.